Now, I realize this title looks like clickbait, right? Well, while the media reports on what's happened, I have the luxury of sharing with you guys what's actually happening out there. And let me tell you, we have so much to unpack today. Now, if you recall, I made a two-part video series back in November explaining why this housing correction was nothing like before. And in the second video, I explained how and why the market was likely to come back quicker than we even expected. Well, it appears that the market is back and even quicker than I had anticipated. Now, while I literally have no idea why buyers came out en masse the week right after Christmas, I can tell you what's about to happen based on some recent developments and buyer activity. So today we're going to quickly cover the normal Las Vegas numbers before we discuss mortgage rates, unemployment, and what effect all of this is going to have on housing over the next few months. So without further ado, let's get right into it, guys. First up, let's check out last month's sales. Last month, we sold only 1,130 homes. This was a 53% decrease over last January when we sold 2,410 homes. Now, to add some context here, this marks the sixth straight month of declining sales, with the previous 4 months consecutively marking the worst month of sales ever. Last month alone, we sold 400 less homes than we did during quarantine in 2020, pandemic time. So let that just sink in. But now check this one out. While we only sold 1,100 homes last month, we currently now have about 2,300 homes under contract. Remember that one for later. Next, let's see what result this had on median prices. As you can see now on the screen, after 7 straight months of price declines, we finally managed to plateau out at $420,000. Now, this is actually great news. It's not uncommon for the median price to decrease in January during even a normal housing market. Now, homes that close in January are homes that went into contract in November and December, which is also bargain hunting season since sellers are more motivated and there's less competition from buyers out there. Okay, now for the most important metric to pay attention to, current inventory levels. We ended January down 12% with just over 5,700 homes on the market. More importantly, last week alone, we lost 5% of our inventory to drop to about 5,400 homes. Again, remember this number for later. Now let's check out some high-level statistics in the form of housing saturation by price range. Now, I track this to show how competitive the market is over multiple price ranges. Now, the higher the number, the more competitive. So let's start off with our largest market segment, homes priced between $250,000 to $500,000. The numbers just don't lie here, folks. We went from 24% saturation to 34%. That's a 10% jump in a month. To be fair, when inventory decreases, having the same amount of homes in contract increases the percentage just by nature. I mean, it's basic math for you. But this is much different. Ironically, we have the same amount of homes on the market this month as last month, but instead we have 500 more homes under contract. Guys, that's huge. Next, we have 500 to 750. This increased as well from only 17% up to 23%. Next, we have the roughest segment of homes priced between $750,000 to $1 million. Even this rose from 15% to 19%. Now we get to the luxury end of the market, homes priced between $1 million to $1.5. This increased 4% from 17 to 21. Now, last but certainly not least, are ultra luxury homes of over $1.5 million. This marginally increased by 1%. Now, one observation here though, while the regular market was either identical or marginally lower with regards to overall inventory, only the luxury market increased its inventory. So even though the luxury market has more homes that are available, they still managed to increase by demand as well. Okay, Now that we've seen the data, what in the hell does all of this actually mean? And why do I seem to be so irrationally bullish on this market when I've been telling everyone not to rush out and buy for months? Okay, now I'll admit, I have no friggin' idea why everyone decided to just come out and purchase right after Christmas. Nobody saw this coming. My phone started blowing up, and frankly, I didn't think this was gonna happen for at least a few more months. Now, rather than cry wolf, I figured I'd be a little conservative and see if this lasts or if it's simply an aberration. While a few recent national reports have shown sales are up in December, the media isn't likely to report much on this for about a month. Look, January sales were miserable. You can't get around that. But look at all those pending sales. February certainly will not be down 50+% again. My guess is more like 25% down. I don't think prices are necessarily going to jump next month either, but while this newfound activity is happening, it won't be long before the media changes its tune and pundits become bullish on housing again. And here's why. First, while the tech industry was laying off 50,000 employees, the whole economic climate became bearish. Well, with the recent jobs report showing the lowest unemployment since 1969, it flies right in the face of doom and gloom perspectives. Next, let's talk rates. Now, if you remember in my housing recovery video, I explained that there was a direct relationship between rates and price decreases. At some point, both prices and rates will decline to bring parity to where we were last year when we had 3% interest rates. Now, we're not quite there yet, but median price is down over 13%, and now interest rates broke below 6%. I just had a client pre-approved for $2 million at only 5.5%. Now, I'm going to do an entire video soon that explains how mortgage rates are determined, but without going into tremendous detail right now, check this chart out. Now, while most people tend to think that the Fed rate directly determines mortgage rates, the truth is that mortgage rates are tethered to the 10-year Treasury bond rate, which this chart depicts is the relationship between the 10-year bond rate and mortgage rates. Now, you can see this direct correlation going back to 1971. The bottom line here is that the average delta between bonds and mortgage rates is 170 basis points, or let's just say 1.7%. So if bonds are trading at 4%, mortgage rates tend to be 5.7%. Well, right now, the mortgage rates are trading at about 2.5% over the bonds. Again, I'll explain all of this in more detail in an upcoming video. But what all this mumbo jumbo means is that investors have been bearish on mortgages, so they're charging more to purchase them. Well, it's inevitable that once all this fear subsides, mortgage rates will come back to 1.7% over bonds, which ultimately means that rates should come back down about 3/4 of a point. Put even simpler, this means that rates should come back down to about 5.25% here in the forthcoming months. So for the grand finale, let's check out this stage that's been set for us. Covertly, buyers have been coming out in droves, which will soon result in closed sales. The media will then report a surge in housing demand yet again. Prices have stabilized and rates are likely to drop into the low 5s. You got a year's worth of buyers who sat on the sidelines waiting for the smoke to clear. And in typical fashion, they're likely to all come out at the same time due to fears of increasing prices soon. And guess what? When you're only selling 1,100 homes per month, 5,500 homes on the market translates to a 5-month supply, which is perfectly stable. But when you go back to selling 3,000 plus homes per month, suddenly you're down to a 7-week supply of inventory. So potentially, by late spring, we could have no inventory, low interest rates, and hyper demand due to a backlog of buyers. Now, will this translate to crazy town all over again? Maybe, maybe not. But unless we can motivate sellers to purchase new homes and list their current homes for sale, supply will be the main issue. So, moral of the story, I think we've already hit the bottom, folks. it certainly seems as though the proverbial bottom was back in December. So if you're looking to purchase, I would actually get hyper aggressive right now and hope you can find a motivated seller willing to negotiate with you. Now, I'm afraid in the next month or so, sellers will realize that this market's heating up and all of these builder incentives and seller concessions are going to go by the wayside. Now, if you're looking to sell, suddenly the momentum is on your side again. I'd monitor this market and especially inventory very closely. And I'd be looking to list in mid-April so you can catch the upswing. This also gives you plenty of summertime to make any adjustments if needed. All right, well, that's it for this month. Now stay tuned for that deep dive on how mortgage rates are determined. Please be sure to like this video and share with your friends after you subscribe. Have a wonderful February, everyone, and I'll see you all in the next one. Deuces.